Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about why 529s are overrated. And Justin, we have actually talked about 529s before. You have to go all the way back to 2021 to listen to our most recent, before this podcast, about 529s. And it's interesting because to date that podcast, there's a big piece of legislation that has come out that we'll talk about. It's the 529 to Roth rollover. So when last time we recorded, that piece of legislation wasn't even in existence. So this will be a little bit different conversation because that was a more existential, thinking about education in general of like, hey, what is the value of college and how do you fund it? This is specifically talking about the 529 plan. Where do you want to start this conversation?
Jared, there's so much I want to talk about with 529s. I feel like I have a different answer in terms of, do I personally want to allocate funds to 529s? Should our clients put money in 529 plans? And then, Jared, I really think if we look at five kind of different families, I might have 3 or 4 different answers on how to approach 529 planning across 5 families. And so there is an element where, hey, there's some universal truths with them. There's kind of some textbook financial planning answers, but there's a lot of variability and there's just a wide spectrum of how you can approach the decision of how to pay for college.
Would you agree with the assessment that 529s are overrated?
Yes, I think 529s are overrated.
Yeah,
I do.
And to be clarified, that doesn't mean they're valueless. That just means relative to the hype and the energy and attention that's bestowed upon them, might be a little overrated for reasons we'll talk about. Justin, and which reason? I know we kind of have a few marked down. What reason do you want to start with in terms of why you think 529 plans are overrated?
I think the biggest thing for me, the number one point for me is when you look at a balance sheet, like your balance sheet, a personal financial plan, look at a personal list of your assets, you're going to look at assets in different tax registrations and different account entities, right? And so you might have some funds in a Roth IRA, in a 401k, in a checking account, in a CD, high yield savings account, and then brokerage investing. Jared, at the end of the day, brokerage or non-retirement dollars, those are really important dollars for the vast majority of families, even families that are doing very well financially and making, a top 1 or top 5% income. So even at the top of the food chain economically, there is still enormous competition for those kind of sacred non-retirement dollars. So the question of, are you going to allocate them to a 529? It is a zero-sum game, right? If you're putting, let's just go with the annual gift exclusion. If you're putting $19,000 into a 529 plan, well, that means that $19,000 is not going into something else. So I think that's my beef with it. But where would you start?
Yeah, I think just the thesis is the 529 plans are more valuable the earlier you start. But it's kind of a circular reference because if I have a 15-year-old and I start funding, the value of the 529 plan is less valuable, but my range of outcomes in terms of what I think this kid is going to do or use the funds for, or if they're going to need the funds.
So much more clarity.
So much more clarity versus, my son Ellis, who just turned 2, figuring out, this is the time to fund it. And you and I will talk about our personal approaches, but the time it's best to fund it, it's the hardest to know. So figuring out the range of outcomes is super wide. So you getting really precise and close to that is just really difficult to do.
It's a good point, but I think we can all agree that Ellis is going Ivy League, right?
Yeah. If it were up to me, he played lacrosse like I do, and I wouldn't have to pay any out of pocket. But so the first part is, so it's really difficult to know. The next part is the cost of being wrong is high, right? So if you think about a non 529 plan, and you say, hey, I'm gonna fund a 529 plan. You have one kid, your kid ends up getting a full ride to play lacrosse somewhere, and you want to make distributions from that account for non-education purposes. The appreciation is taxed at income rates, and there's a 10% penalty. Conversely, if you would have just put that money in a brokerage account, that's taxed at capital gains, right? So to put like really crystal clear math on it, make it super simple. If you have $100,000 in an account, 50,000 you contributed, 50,000 in appreciation. If I make a distribution from a broker, let's say that's in a brokerage account, and I go and spend it on, down payment for a vacation home, I'm going to pay, $50,000 in appreciation times 23.8%, which is the top capital gains tax bracket with a little surtax on there. Estimated taxes of about $11,900 on making that $100,000 available to me, right? Because $50K is my investment, $50K is the appreciation tax at cap gains rate. Conversely, if Ellis doesn't use the 529 plan and I have that and I want to use it to fund the second home, okay, $50K in my investment, not taxable. The $50K that was appreciation, it's taxed at income, not capital gains. And if I'm in the highest marginal tax bracket, that's 39%. Plus a 10% penalty. So in that scenario, I'm paying an estimated tax rate of $24,000. So more than double the tax for the same amount of appreciation just because the bucket it's in is tax advantage exclusively for education. So like there's a lot of optionality given up in that scenario to me.
And Jared, your example is so helpful, but your example's also potentially worse than it could be in reality. Or let me phrase it this way. The capital gains benefit could even be better because you could time the capital gains to where you're not at the highest capital gains tax bracket. You could time it to where you don't have the extra net investment income tax of 3.8% tacked on there. Jared, you could also be someone who does annual charitable giving, and then you could look across your balance sheet, and instead of giving cash, you could give that $50,000 appreciated security. And then you could just spend the cash. So there's so many more options when it's in a brokerage account. There's so many more tax options. There's so many more distribution options. It's just significantly more liquid, right?
Yeah. And I mean, too, right? Like if your kid doesn't go to school, but you want to use it for your kid and your kid wants to buy a home and you want to help with the down payment, right? Like
tough luck.
Yeah. Tough luck. And you have a big penalty there. But like, you could gift stock in a brokerage account and your kid could have a very different capital gains rate than you do.
Yep.
Right. So again, it's not that 529s are bad. It just really they're supercharged if it's education. And we'll talk about, how some of the benefits are potentially overstated, but you really kind of box yourself in. So there needs to be a high degree of precision and clarity that you are going to use this for education.
Yep. That's well put.
All right, Justin, we got to talk about state income tax deduction next. Because I think and for our audience, most of our listeners are from Texas. They might not live in Texas currently, but spent a lot of their formative years and money-making years in Texas. And Texas has no state income tax. And so I think that's a big con against the 529 plan, in my opinion.
100%. If we were having this conversation in a high income tax state, Jared, we may not have this conversation. 529 planning is better if you're in a state that has a state income tax and you're able to enjoy a meaningful state income tax deduction through annual 529 contributions. I mean, Jared, what do you think about this, though? It also varies widely state to state, right? I mean, there's a big difference between a state that's taxing you at less than 5% on your income versus a state that's taxing you at 12, 13%. But then there's also even more complexity because regardless of your state's marginal income tax rate, well, they may have governors and limits on the deductibility of 529 contributions. So you may not be able to do the mega fund. For our listeners, quick definition there. Mega funding of 529 is when you lump 5 years of the annual gift exclusion into 1 year. Jared, so what does that even mean? Right now, the annual gift exclusion is $19,000 a year. So then theoretically, you could lump 5 years of $19,000 gifts. So that is $90,000 that you could kind of mega fund a 529. But if you're in a state income tax state that has a limit on 529 contributions, you may not get to realize all $90,000 of a deduction there.
Yeah. And we'll make this super tangible, right?
Real quick, Jared. Yeah. apologies to my audience for my mathematical
95, it's 95,000.
95,000. I can't believe you were just going to let me get away with that.
I see. Sometimes we'll plant nuggets for hopefully to create engagement, right? I would have loved for somebody to see like, hey, it was 95, not 90.
Yes.
But I did notice that. I was just gonna let it ride.
What's funny is, the IRS changes the contribution limits on basically every different type of plan, year in, year out. So it used to be 18,000, and then the math would have been right.
That's the problem with the tax code. The moment I get my arms around it or get the numbers memorized, it changes.
I think we got to blame the IRS on this one.
Yeah,
I shouldn't be blamed for that math error.
Yeah,
it's all on the
one
IRS.
One of the craziest examples of this. Quick aside: when I was studying for the CFP, they passed the Tax Cuts and Jobs Act in the middle of it.
Oh my!
So, but I was phased into the old tax code. So I was studying tax code that was irrelevant.
That is miserable.
Yeah. And I knew I was going to have to forget it all. But like the phase in of the way the exams worked, I spent a good amount of time studying tax code that I knew was no longer relevant. So
that's amazing.
Yeah. So that's okay. So let's talk about Arkansas, right? Because like that's where I just moved here from. And like this is a good example to kind of illustrate this point you're talking about of like, hey, it really is state dependent, right? Like California, New York, you're talking about a top marginal bracket of, greater than 10%, but Arkansas's top marginal bracket is 3.9%. So like if I do the math, and of course there's filing caps too. So, married filing jointly, you can $10,000 reduces your state income taxable, state income tax liability or your income for computation of your state income tax liability. So if I make 18 years of contributions and my effective, that's $180,000 and I'm doing, $10K a year to get the maximum state income tax deduction, but my tax rate is only 3.9%. I saved an estimated $7,000 in taxes.
Over 18 years.
Yeah.
So you're saving like a couple $100 a year or so.
My time would be better spent signing up for a credit card, honestly, one credit card a year, and kind of playing that game, which I would love to have a podcast talk about that because I'm in the weeds. But like that's like a really good example of like, okay, what's the return on that? Like, and then the other problem is I have to make the contributions over 18 years. We'll talk about it later, but like, what makes 529 plans really work is having a high percentage of appreciation and using it for education because you don't have to pay taxes on the appreciation if it's for education expenses. If I'm funding 180,000 cumulatively, I'd be much better off from an appreciation perspective if I funded it earlier and in lieu of the state income tax deduction.
I want to repeat what you just said in a different way because it's a very important point. So in this Arkansas example, you would think that the way to optimize your tax situation is to make annual contributions like $10,000 a year so that you're able to enjoy the state income tax deduction for 529s. But that is not how you optimize a 529 in Arkansas for taxes, most likely, depending on market returns. If you really want to optimize it, you're far more focused not on the annual state income tax deduction. Instead, you're focused on the kind of Roth aspect of a 529. You put money in and it grows tax-free, and then you can take it out tax-free, assuming it's a qualified educational expense. So the way to optimize it, if you're trying to optimize for taxes, is really to ignore the annual state income tax deduction on contributions and instead just enjoy that tax-free growth, which, again, I want to kind of make sure we're super, super specific here. That goes back to the point you made with your son. It's a really tricky dynamic. Your son is 2. And so the way that you really get the greatest tax benefit is you put a ton of money into a 529 right now or 1 or 2 years ago. And you allow more than a decade and a half of tax-free compounding. That is a greater benefit than a tiny annual deductible portion of a contribution.
Yeah, that's exactly right. So it's there's trade-offs in terms of timing, right? And and I would say the state income tax deduction can really cloud your judgment.
And I want to repeat something that you also said 5-10 minutes ago. That is the conundrum here. The greatest tax benefit is the way to plan this out is to put a lot of money in a 529 when a child is very, very young. I'm starting to get on the other end of that spectrum from you, Jared. My oldest child is 11. And guess what? We don't know exactly, what higher education is going to look like, but we do have more clarity than we had when our kids were 2 years old. And so that's the conundrum. Greatest tax benefit is put a lot of money in there very, very early. But to Jared's point, you're just not going to have a whole lot of clarity on what higher education is even going to look like for your child specifically. And so you might be allocating dollars that, who knows whether they're going to be used or not.
Yeah. Yeah. And I mean, that's the thing is like, I think this conversation is the 529 plan worth the restrictions, right? It's like we're staunch advocates of, hey, let's fund this expense and like, let's mentally account for it and make sure we're saving towards it, assuming you're saving for retirement appropriately, right? Or that your retirement nest egg is growing appropriately. But like, is this container and the constraints that it creates worth it? And I might say, yeah, it's probably what I'd say.
I think that's a really good point. Another way to phrase this, if you're in a situation where you have, maybe you have enough assets to eventually retire, but you're not going to have significantly more assets than you need, well, then I would make a strong argument to forego 529s. I would probably make the argument, don't pay for college for your children. You cannot wake up at 72 and if you've already retired, you can't find a way to restart your career in most cases and continue earning years. But your children can. And so you never want to be in a situation where you're allocating dollars to a 529 and that puts you in a precarious situation in retirement. And so I think it all goes back to what we've said. Excess discretionary dollars for investment are a little bit quote unquote sacred. And so you need to be very careful about how you allocate them.
Yeah. And I would say there's a segment of our audience that isn't solving, hey, I have tons of excess cash flow. My main problem is like an estate tax problem. And to that portion of our audience, I would think about direct tuition payments, right? Like if you're in the bucket of, hey, I'm just trying to get money tax deferred away, use my annual gift exclusion, crummy trust could make more sense because there's more flexibility, not the same constraints, or having grandparents pay tuition payments directly, right? So like if I make because tuition payments are a non-reportable gift. So if if my kid goes to a small school and to a small, liberal arts college and it's $40,000 a year, I could have an in-law or a parent pay that amount and then also make annual gift tax exclusion or annual gift exclusion. And those don't, those aren't aggregated. And so there's a kind of a unique wrinkle there where, maybe it does make sense to just pay out of pocket because how, tuition payments are coded from a gift tax perspective.
See, that's why this is even more of a hairy topic, because there is an element where for the first 10, 15 minutes of our discussion, Jared, I was thinking that, if a family has, let's say it's 50 million or 500 million or 5 billion, well, then it does make sense to just allocate to a 529 and put $90,000 in there when a child is very young, because you have more assets than you're going to spend. So that's a great way to allocate them wisely. But the point you're making is something I want our listeners to make sure you understand. That's a very important point. Tuition payments are not a reportable gift. So if you do have a really substantial estate, well, one of the biggest things you're trying to think through is how do I get money out of my estate in the most efficient manner? And let's say you have 4 kids, maybe you have 10 grandkids and 4 of them are in college at the same time, and the total tuition payments on an annual basis are $200,000 a year. Well, as a grandparent, you can pay those $200,000 tuition payments and it doesn't even count on your annual gift exclusion. And so all of a sudden, that's a really strategic way to just go ahead, make those payments and still make annual gifts on top of other significant estate planning, obviously. But that's the fascinating point there. Even if you have far more assets than you're going to need, it's still a tricky question on what's the most efficient way to approach college funding.
Yeah. But so again, we're not making the claim that 529s are bad. They're just overrated. When might it be a valuable tool? What segment of our audience, and there's probably people thinking about, but what about the Roth IRA, the Roth IRA rollover of 529 plans? Who are 529 plans a good fit for? It sounds like we kind of talked about people that are starting early so that they have a lot of a lot of their account balance will be appreciation versus contributions, right? And they have a decent idea that they'll pay some form of higher education. Who else or what people in what situation might 529s kind of make sense for?
I think it often makes sense for a younger family that has one of these two things that are true of them. One, they have a really substantial income and a high probability that high income is going to continue for decades. And then the other one is you might be a young family that already has really significant assets. Because in both of those situations, what is helpful with a 529 is you're effectively labeling those dollars. You are allocating those dollars. You're putting a purpose to those dollars within your balance sheet, and you're kind of setting them aside. I want to add another factor. So, Jared, we've talked about the unfortunate reality that if you overfund a 529, you're really dinged on it. So another factor here is if you have 4 or 5 kids, it is a no-brainer to really mega fund a couple or a few 529 plans. Our audience, you may already know this, but it is important to remember. You can change the beneficiary on a 529 really whenever you want. And so it's not a big deal if you end up, let's say your oldest child gets a full ride scholarship and you don't need to use any of that 529 plan. Well, if you have a lot of kids, you can just change the beneficiary to the next one. And then I think the other element is worst case scenario, you can also change the beneficiary and play a very long game and skip a generation. Right. And so you could have maybe it's overfunded for your children, but then you could wait for grandchildren to come along, change the beneficiary to them. And so that can be a use. So I think, Jared, the 10-second version of what I'm trying to say, a 529 can make sense if you have significantly more assets than you're likely going to need or income mixed with enough children for it to kind of hit the sweet spot.
Yeah, I would say, 529 beats taxable brokerage, but it's a function of what are the odds these expenses get these funds get used for college, right?
Yep.
And it doesn't have to be it doesn't have to be this kid's specific college. So if you have more kids, odds go down. A private school is also eligible. So if you have, you're going to send your kids to private school, the odds of this bucket that you've earmarked for education expenses, if you have a bunch of kids, if you're going to private school, or if you have substantial assets and you can change beneficiaries to, grandkids and you're okay with that outcome and your retirement isn't contingent on doing that, it could make a ton of sense. And I just want to talk about the Roth really quick because there's a lot of buzz in the media about, hey, there's a Roth conversion option.
And it's just not that big of a benefit.
I mean, the limit is low. The cumulative amount you can fund is $35,000, to be clear, which isn't nothing, especially if you get it in while the child is younger, because, compounding can do its thing. So that's a material amount of money. But the account must have been opened for 15 years, right? So I would argue, when does a 529 make sense? When you start early. And when there's a high probability that it's used for education. So like the Roth rollover is kind of interesting. And then it has to be made, you can use annual contributions, which the current rate is, the current limit is $7,000 a year. So 5 years of $7,000 a year gets you to the $35,000 that you can convert from 529 to Roth. Again, which isn't, that's a material amount of money. But again, if you're trying to fully fund education and you overfund, this isn't going to take all that money out tax-free.
Yep.
Right. So I think it could be helpful, but again, you want to make a measured approach with college funding because there's not a lot of eject buttons that don't involve substantial taxes.
That's a great point. And I'm glad you mentioned private school on the K through 12 level. That is a huge factor that I meant to mention in my prior point. If you're in a situation where your kids are going to go to private school, well, that makes it much more likely that you're going to be able to spend it. Jared, I will say that if you have kids that are under 5, you're planning on doing private school, and you have really significant assets, I do like the idea of mega funding. But even then, if I'm in Texas and there's no state income tax deduction, I am tempted to still maybe cash flow the first few years of elementary school just so that I can still realize some of the actual benefit of a 529, which is tax-free growth. You're not getting a huge tax-free growth benefit if the money is in there for 18 months. you're getting a huge benefit when it's in there for 4 years, 8 years, 12 years, 18 years. And then when we think about the kind of multiple generation approach to 529 planning, private school is a huge deal there as well. So let's say that you do significantly fund a 529, and let's say it grows to $400,000, and well, your oldest child gets a full ride. And let's say you do need to kind of then wait for them to have kids. Well, if there's several $100,000 in a 529, but there's multiple grandkids doing private school for all of K through 12, then you're okay. That's probably going to be used. But it goes right back to what we said of it's really hard to plan those things out.
Yeah, and everybody's approach is different, right? I think like I'll kind of end here. Like I got to caveat this with I have a 529 plan for Ellis, right? And like what led me to make that decision, I think, is principally mental accounting. Right.
Yep.
Like I just love the idea of like having a bucket of money that I know is earmarked for those expenses. And I could commingle them with brokerage assets, but I don't really want to. I kind of like having that. And I'm also, I'm a points nerd. So like I'll over optimize and it's completely dilutive. But like the idea of getting the state income tax deduction is not financially meaningful, but it feels nice. Feels like I'm sticking it to the man a little bit.
Yeah.
But I think it's personal for everybody. But now that I'm in Texas, I'm a little less inclined to do it. But I think inertia is a powerful thing. I'll probably keep funding it just because I am, and it's easier, and it's mentally kind of spoken for and accounted for.
Okay, this is helpful. So you have a 529 and are funding it. I do not have a 529 for my kids currently. And will I set one up? I'm not opposed to it. And I also look at your situation, Jared, and I think that's fantastic. I think that is a good financial decision. So I'm not wholly against them by any means, but for me, it goes back to the competition of discretionary non-retirement dollars. And right now it doesn't make sense. We want to pursue other things. But I don't think that's a universal answer.
Yeah. And I mean, I think that's where we'll kind of land the plane is like, it's very personal, but I think to say, hey, this is the best account. I'm funding college. This is the account I need to use. I think it's simple, but it might not be optimal. So think about your situation, what you want, how you want to provide for your kids, what that looks like, and the probability that this account gets used for education and that it doesn't undermine your ability to retire successfully. Well, awesome. We'll wrap it up there. Always love chatting about education, and especially love your vantage point because have different approaches and different age kids. So it'll be fun to kind of see every 5 years, we probably need to check in and see how our stances change because it's evolving as tax laws change, our kids get clarity. And so it'll be fun, ongoing conversation. I'm sure when we record an updated one in 5 years, there'll be new tax law to talk about. So until next time,
it'll be great.
Emails for future podcast episodes. podcast@BrowningWealthManagement.com. Thanks. We'll see you next time.